All right, credit default swaps have become a widely watched indicator this year, but what are they indicating? It's not always very clear. Well, where Greece is concerned, some have said that CDS spreads going from a low under 800 to a high of nearly 7,000 means that traders are pricing in a 90% probability of default. But what does it mean when Goldman Sachs CDS spreads go from 100 to 400 in just a few months? Even Goldman's CFO, David Viniar, had to admit during this week's earnings call that he's, quote, confused. Well, joining us now to make sense of it all is Conrad Voldstad. He's CEO of the International Swaps and Derivatives Association. And Conrad has a long history on Wall Street. He was the first head of global derivatives at J.P. Morgan. He also ran the global debt markets group at what was at the time called Merrill Lynch, which is now part of B of A, of course. Absolutely. Conrad, it is great to have you here on Street Smart. Let's talk about ISDA and the role ISDA plays in the greater universe of credit default swaps.
Okay, well, ISDA is the International Swap and Derivatives Association. We were founded about 26 years ago, primarily to standardize documentation and make sure there was legal certainty. Over the last 5 or 6 years, the association has grown, and we've spent a lot of time working with regulators to standardize things like credit default swaps, the process, the instruments, and indeed how the defaults work. We have over 800 members in 50 some odd countries, including 60 governments are members of ISDA.
How big is the credit default swap market at this point? We talked, of course, earlier this morning. I worked in credit derivatives, but not that much has changed from then until now. It seems to, though, have gotten much, much bigger, but yet the volume is still not nearly what we think of when we think of the corporate bond market or equities.
That's correct. The aggregate amount of outstanding CDS is about $28 trillion. It sounds like a very, very large amount, but of that, 15 trillion or so is for single names. The rest is for indices and forms of indices. So you have 15 trillion of single name, 13 trillion of indices. Then you have, you can net it all out, though, and say, what is the open interest? How much risk is actually out there? And it's only about $2.5 to $3 trillion. And virtually all of the credit default swaps are collateralized, and they're virtually all collateralized with cash. So you have to post the cash based upon the market value of the
There has been quite a bit of hullabaloo around credit default swaps as it relates to what is happening in Europe. In fact, we had Mark Grant on earlier in the show of Southwest Securities saying, who knows what happens with credit default swaps, in the event of a forced default in Greece. But your view is that there probably won't be that big of an impact, will it?
Well, there's about $3 billion worth of credit default swaps outstanding. That's the net position.
Puny.
It's puny. The government bond market is about $450 billion. So it's a very, very small amount of money. It's all collateralized in terms of the market value, and the market value of these things is only 40%. So if you sold protection, which means you're long the bond, you've had to pay 60% of cash collateral. So the amounts are really relatively small.
So it's not really going to shake the foundations of the global financial system in the event.
We don't expect that at all now.
Okay, so it's not going to make anything necessarily worse over in Europe at the moment. But let's talk about the credit default swaps on Greece. I mentioned this in your introduction that, we went from 800 to nearly 7,000. We've heard different interpretations of what that means exactly. All I know is that it's a big move. It's hard to tell, though, what the volume is on any given day. And it's hard to know how a default probability is implied from that number.
Well, you can work it out because right now, if you buy protection, you have to pay 60% up front, and you get 5% a year. And you also factor in a recovery rate if indeed there is a default. And so you can work out that it'll be roughly 90%. But you could do exactly the same thing from the price of the underlying government bonds. They're trading at 35 to 40 cents on the dollar. And if you'd run the same math, you'd find that it would be a 90% probability. It's only a market guess, though. That's what the market thinks. It doesn't mean that it's going to happen.
So on any given day when I'm looking at credit default swaps, whether it's Goldman Sachs or Greece, what should I keep in mind? Should I be taking some of these numbers with a grain of salt?
You should just understand that that's a current picture of today's marketplace. And the credit default swap market is nowhere near as liquid as the sovereign government bond market is. It trades much less frequently than the corporate bond market. We do trade in bigger size, but it's very visible in terms of one price for one name, which you don't get in government bonds. You don't get that in corporate bonds because corporates could have hundreds and hundreds of different issues outstanding.
And
so it's an interesting
be a few trades on any given day in the most active of those individual securities.
There's an interesting, I can give you some numbers on this if you don't mind, because the New York Fed published a report on the CDS market a couple of weeks ago. They took all the trades from for a 3-month period back last year. They found 48 names that were considered active, and they traded 10 times a year globally, 10 times a day globally. That was the average trade.
Right.
The next 200 were 4 times a day, and the next 1,500 was less than one time a day. So it's really a very, very small institutional market. The Fed also said there are only about 1,000 names that actually 1,000 participants in the marketplace.
All right, Conrad, we have to leave it there, but do appreciate the credit derivatives one-on-one, if you will. Great to have you.